the whole idea that you would let people borrow more on lower interest rates, I think it is really quite dangerous.
Brian Johnson, welcome.
Thank you.
On the program yesterday, we ran a story about the big banks essentially falling over themselves to cut fixed home loan rates to win customers. You're fresh from reporting season. Is this the real story of the banks, do you think?
Not really. In Australia, most people don't actually take fixed rates loans, and it's probably running at about 5% of the flows. And you certainly wouldn't be racing out to take a fixed rate loan if you thought interest rates were going to fall. So, you know, the actual level of interest rates perhaps isn't the really big story on banks that you would normally think. The banks have got quite big hedging portfolios. And what that effectively means is they're more sensitive to moves in bond rates than they actually are to moves in the cash rate. So I don't think it is really a gigantic story, apart from one thing, and that is the lower rates go, the more people can borrow, the more they drive up house prices, which makes us all feel a lot wealthier, but we're still living in exactly the same house we were living in the day before.
Well, interestingly, I mean, Australian households are among the most indebted in the world. How much more debt can households take on?
Well, perhaps we could express that another way, is that as you let households get more indebted, it really destroys the ability of the RBA to basically hike interest rates. And to me, it actually is really quite puzzling that not all that long ago, we were talking about the pace of interest rate hikes and what distress that was causing to probably a third of households. And now we seem to be making the same mistake. The whole idea that you would let people borrow more on lower interest rates, I think it is really quite dangerous, but that's probably a debate for another day.
Do you think the regulatory environment then is getting in the way of bank profitability?
I don't think it's so much the regulatory environment that is, but I think it's just the sheer mechanics of how much money was pumped into the system during COVID. So before COVID, there was about $999 billion of household deposits. There's now probably closer to $1.6 trillion of household deposits. They're not evenly distributed, but there is just so much money slopping around the economy that what it means is for the third of households that had debt as interest rates have risen, that's become a real problem. The third of people that have got no debt and have basically got savings, high interest rates have been really great. And the third of households that sit in the middle that are renters, they've obviously faced real distress. But this is the real problem, is that the impact of interest rates is not felt evenly across the economy. Different groups basically get hurt as rates move, and that's kind of unpalatable, but that's just the reality of the way it works.
Well, if we look at the group that does have home loans, yesterday CBA's quarterly update showed that home loan arrears rose 5 basis points to 0.71% in the quarter. Matt Common said he was comfortable with that. Are you?
Yes, I am, but I think Commonwealth Bank is in a pretty unique position. When we think about what happened during COVID, the banks put away quite substantial provisions, but the reality is that ANZ and Westpac have written a large element of that back, whereas CommBank and NAB have maintained them. Now, that's a long-winded way of really saying that for CBA and NAB to really face a major loan loss cycle, we would have to have conditions feel worse than they did during COVID. For ANZ and Westpac, it's a little bit different to that, but CommBank comes from a position of stronger than peer capital, stronger than peer provision coverage. Just every measure you look at CommBank, it certainly looks to be more resilient than the peers.
How hard is it for the Big Four to chase growth from here? Where can it come from?
Well, the problem that we've actually got, and like for ANZ, I've got the numbers kind of top of mind, but ANZ's loan loss charge in the half was about 3.5 basis points. Their stated long-run loss rate is 19 basis points. So the real problem is, depending on how long it takes to get back to these long-run loan loss rates, that's what will decide whether profits grow or not. The other dynamic that we've got is we've got rising capital intensity, and this really does raise the spectre of dividend cuts across the sector, regardless of what really happens on near-term earnings. So these are much bigger problems for ANZ and Westpac than they are for CBA and NAB, but certainly it's not unreasonable to think as loan losses kind of like revert to more normal levels, EPS growth perhaps could even go negative, but certainly dividends probably fall more than actually the earnings do because the capital requirement is going up.
Does that mean share prices are going to come down?
Well, I've thought share prices of the Australian banks look quite ridiculous now for quite a while. But if we have a look over calendar year 2024, we had an environment where banks massively outperformed the market. And what it was the lack of alternative investments in Australia. Like, you didn't race out and buy resources stocks over calendar year 2024. The banks, by definition, are a gigantic proportion of the market. And as fund managers went to basically try and move everything back to more of an index weight, the banks were the biggest beneficiary of that. I think that trend is still continuing certainly into the March 2025 quarter. But over and above it, something that is often ignored, from 1 July, superannuation contributions go from 11.5% of salaries to 12%. Given the way that dividend franking works in Australia, it feels to me like that's even more money going to the equity market chasing these stocks. And quite regardless of valuations, it probably means that the share prices could yet squeeze higher. So I despair because I'd love to be in a market where I could tell you things were cheap or expensive, whereas when I look at it now, I actually think most stuff is expensive.
And one stock in particular, CBA, is trading at around $168 a share. We've been talking about it trading outside of its fundamental valuation for quite some time, over a year now. You don't see that coming down?
Well, Alicia, we've been talking about Commonwealth Bank being expensive relative to the other banks for about 20 years. And that hasn't stopped it significantly outperforming the banks and the rest of the market. And you know, when we think about CommBank, it's complex to run through, but in essence, if I bought my shares in the float at around $5.10, I'm somewhat hesitant to sell any of my shares because of realising capital gains tax. Institutions are underweight, so the more it goes up, the more painful it is, the more they've got to buy it. And so on CommBank, its share price is divorced from reality, but it's a bit hard to see those dynamics that have been driving the share price really changing it. And the other thing that really helps out Commonwealth Bank, it's got a far better balance sheet, a far better franchise than the peers, and it is demonstrably out-executing the other banks, which means it is creating more shareholder value than the other banks. So I'd be the first to admit its share price is expensive, but I think I can't see, absent a massive fall in house prices, which I also think is unlikely, it's a bit hard to see what sees Commonwealth Bank derate from these very expensive levels.
And a really quick one, Brian Johnson, before we let you go. Which banks do you like more than the others?
Well, as an old person, I like quality and I don't really like risk. I can't get to any of the values on any of them, but I think NAB offers better value in a relative sense than the others. I think CommBank is a dangerous stock to underweight, so that's the pairing I like, NAB and Commonwealth Bank. And on ANZ and Westpac, it just feels to me they're a little bit riskier. You've got these gigantic IT initiatives that they're taking which create yet more risk, but you've also got brand new CEOs coming in. And if I'm a new CEO, there's work to be done in the early years to set it up for the longer term, but that may well equal strengthening the balance sheet over near-term earnings. So I much prefer NAB and CBA to ANZ and Westpac.
Thank you so much for your time.
Thank you, Alicia.